Welcome to the Accounting X podcast. Practical content each week to help you and your finance and accounting teams succeed in the digital world. Episode 1. Financial reporting challenges when group companies have different operating calendars. Many businesses are held back by inefficiencies in routine processes within the period-end financial close and reporting process, making it difficult to progress to value-added research and decision support. Our guest for today is Mark Richardson, co-founder and CEO of Mondial. A qualified accountant, ACCA, for over 35 years, he has also spent over 30 years providing leadership and direction for leading players in the ERP space including SAP, Sage, Epicor, Avalara, and Plex Systems. Mark is a specialist in product positioning, messaging and launch management, and has become an established thought leader in the global accounting and financial reporting software sector.
So most businesses operate over the course of a financial year, right? The financial year is normally, and as you'd expect, a period of 365 days, and it's used to tally up the performance of the business over that period, report to the company's stakeholders, and also to calculate the company's obligations such as tax or interest and so on. Now, in most cases, each financial year is then divided internally into smaller, more manageable time periods. This is known as the company's operating calendar, and the individual time periods within it are known as operating periods. Now, these operating periods create additional inflection points during the year. They allow everybody to work together towards a series of shorter, manageable intermediate targets. And in turn, they allow the management of the company to more carefully track performance and then make course corrections where necessary.
Why do companies have different operating calendars, and why can't it just be one?
Well, depending on the type of industry in which a company operates, different businesses may, either by design or just by tradition within the industry sector, use operating periods of different lengths. And they do it to make the performance of the business easy to monitor. So many businesses, of course, operate monthly, simply following the traditional calendar and treating every month as a separate financial period. And this is because it's simple and it's easy to track. However, it can create some problems because different calendar periods have different numbers of days. 31 days in some months, 30 in others, and 28 or 29, of course, in February. And in some businesses, that inconsistency can make comparison of performance difficult simply because the number of operating days is not consistent across periods. In retail, for example, it's very common to set reporting periods up so that a financial year comprises of 13 4-week periods, or perhaps quarters made up of 4 weeks, and 5 weeks, respectively. Because much of retail is high volume and low margin, it's often important that the business is able to view the data on a consistent basis each period and across multiple years. That means there must be the same number of days, the same number of weekends, even the same number of operating hours in periods, so that the trends in sales and the timing of those trends and other operating metrics can be completely understood. So basically, businesses often break the financial years down into periods which differ by industry for internal management and performance reporting reasons that are specific to their business.
What are the different challenges and what is the business impact?
Yeah, the challenges that occur when businesses have these type of somewhat funky calendar periods, different from calendars, They occur when businesses try to consolidate information held in different companies across a group, and that those companies may not be consistent in their use of those reporting periods. So the consolidation issues can occur at both the financial year level and at the operating calendar or operating period level. So let's look at those separately. Let's look at financial years. As we said at the outset, most businesses operate over the course of a financial year, but it's not always possible for every company in the group to have a financial year that ends on the same day. In an ideal situation, every group company would operate on the same financial year, beginning, say, on January the 1st and ending on December the 31st. However, it's not always possible. In some countries, legal requirements determine that companies that operate in that market, in that country, must base their financial reporting on a non-calendar year basis, such as April the 1st through March the 31st, so that everybody in that country reports in the same way. And so that creates a problem at the outset. And then at the calendar period level, or the operating period level, a group may be made up of companies with different operating periods within the financial year, like we just discussed. And, just to reiterate the point, it may be because the companies are in different industry sectors within the group, or it could be a different reason, like they were acquired companies that were set up differently to begin with, or use different ERP systems, and so on and so forth. But whatever the reason, when these situations occur, the group finance team has to find a way to adhere to the differences, yet somehow consolidate reports in a consistent and meaningful manner. Now, to exacerbate these problems, many accounting systems are built with only the individual operating company in mind. It means that while the reporting for the individual entity can be excellent, the ability to then account for the consolidation of the data across multiple entities or multiple companies is weak at best, and in some cases is virtually impossible. So what do we mean by that? Here's an example. Many accounting systems reset their profit and loss account calculations for an individual company to zero at the beginning of each financial year. And they do this by creating journals to transfer all of the prior year trading figures to a balance sheet account called retained earnings. And this in of itself is fine. However, an unintended consequence of this action is that when the finance team comes to consolidate data from across multiple companies, and one has a different year end, the reset or write down of data in that company can significantly skew the results of that company unless the year end write down can somehow be omitted. The ultimate business impact is that finance groups often have to make best estimate calculations. And that creates risk. It creates risk for the business, both in terms of its internal decision-making metrics, as well as in the quality and accuracy of its external reporting.
How can finance and account departments fix these issues?
Yes, so when data needs to be recast and reported across time periods differently from the way in which it's held in the core accounting system, really the way forward is to use specialist software. A lot of companies today spend a lot of time working on spreadsheets to try to map the data to the same time periods, creates all sorts of data errors, creates all sorts of frustration within the business. Now, there are cloud-based systems available today which can import all accounting transactions for each group accounting system, even when the ERP systems are different, and they can store it in a central repository. And now, in addition to storing the transactions, they can store them and sort them on a daily basis. That means they can then create multiple accounting periods upon which to report that data. And they can even identify specific transactions, such as those year-end adjustments that I talked about, which shouldn't be included in certain reports. Now, the impact of that is that it allows companies to then report consistently across the group using the same reporting period set up in the specialist software, even if those reporting periods don't exist in the underlying ERP systems. So not only should the company be able to generate the reports it needs or requires from a single system that's built for purpose, it protects the investment that it's made in its existing systems. Those existing systems work great for operations, and it would be a real shame if they had to spend a fortune on replacing those systems just for improved reporting.
In summary, many companies continue to face difficulties when different group operations use misaligned financial years and calendar periods. The erstwhile methodology of manually manipulating data to produce consistent reports is tedious and can lead to many errors. And making best estimates can create a level of unnecessary risk. The use of modern, cloud technology to homogenize data and the use of specialist financial reporting software can produce huge savings for companies, as the enhanced accuracy of the data provides a foundation for improved decision-making and higher profitability. Thanks for tuning in to this week's episode of the Accounting X podcast. Don't forget to join us next week for another episode. This podcast has been brought to you by our sponsor. Check us out at mondialsoftware.com.